Hello everyone, this is module 3 of capital investment. In this module we are covering cost of capital. In our previous lecture we have covered how to find out the cost of common equity, and in this lecture we are covering the weighted average cost of capital, and this is the final lecture of this module. Now, to find out weighted average cost of capital, we can either use book value words or market value words. If we use book value words, we need to look at firm's balance sheet. From balance sheet, we need to look at firm's value for its debt, equity, preferred stock, and so on. So, by looking at the debt, preferred stock, and common stock on firm's balance sheet, we can find out the book value of debt, preferred stock, and equity. We can also use market value weight. So if you want to look at the market value weight of firm's debt or preferred stock, common stock, you need to look at the market price of firm's bonds, preferred stock, and common stock. So, say for example, market price of a bond of a firm is $900, and total number of outstanding bond is 10. So in this case, market value of firm's debt will be 900 into 10. That's $9,000. The same way, we can also find out the value of firm's equity. To find out the value of firm's equity, we need to look at price per share. Then we have to multiply price per share by the total number of shares of the firm which are outstanding in the market. Now, here is an example of capital structure where, say for example, a firm has a total debt, market value debt of 40 million, preferred stock 10 million, and equity 50 million. So, firm is totally financed by in total $100 million. Out of this, 40 million debt, 10 million preferred stock, and 50 million equity. So, if we want to know the weight of firm's debt, we can divide 40 million, which is the total debt, by 100 million, which is the total source of finance. So 40 million debt divided by total 100 million is 40%. So weight of debt is 40%. Similarly, weight of preferred stock is 10%. That's 10 divided by 100 million. And weight of common stock is 50%. That's 50 million divided by 100 million. So here is the formula of weighted average cost of capital. So first of all, WI into RI. WI indicates weight of firm's debt. RI indicates after tax cost of debt. Then WP into RP plus WP into RP. WP indicates weight of preferred stock, and RP indicates cost of preferred stock. And final one is WS into RR or N. WS indicates weight of firm's equity. RR, if we use RR, that indicates cost of firm's retained earning. We use RN, that's cost of firm's new equity or new common stock. So we have already calculated weight of debt, preferred stock, and equity, and we have also calculated the weight of cost of after tax cost of debt, preferred stock, and cost of retained earnings. So using this weight and cost, the weighted average cost of this firm is 11.30%. So we are assuming here that firm has enough retained earning to finance his investment projects. So if you use retained earnings as a source of equity, your weighted average cost of capital will be 11.13%. So we are not using here any sort of new equity or new common stocks. Now let's look at weighted marginal cost of capital. Weighted marginal cost of capital will increase if firm raises new capital. There are some reasons behind this. First of all, when firm raises new capital, overall riskiness of the firm increases. As a result, firms need to pay more against uh, some of the sources of capital. Like if a firm raises more capital, probably firm might need to pay more cost against debt, preferred stock, or common stock. Then second reason could be when a firm is runs out of its cheaper sources of capital like retained earnings or simply retained equity, the firm is forced to raise new equity, or firm is forced to raise new and more expensive equity capital. So if firm if a firm cannot raise all of its capital from retained earning, has to issue uh, new equity. In that case, the firms need to pay more cost because there is always some cost associated with new equity. In the meantime, when firm raises more capital, investors believe that riskiness of the firm increases, so they will require more return against their investment. So firms need to pay more against new sources of equity, and this is why weighted marginal cost of capital increases if firm raises new capital. This is the calculation of weighted average cost of capital for Duchess Corporation. So we have already calculated this. So firm's weight of long-term debt is 40% and after-tax cost of debt is 5.6%. So weighted cost is 2.2%. Firm's weight for preferred stock is 10% or 0.10. Cost of preferred stock is 10.6% and weighted cost is 1.1. Firm's weight of common equity is 50% or 0.50. Cost, say for example, is 13% and weighted cost is 6.5%. So weighted average cost of capital of Duchess Corporation is 9.8%. Now let's look at weighted average cost of capital for ranges of total new financing for Duchess Corporation. So, for example, Duchess Corporation uses $0 to $600,000. In that case, weighted average cost of capital is 9%. If Duchess Corporation raises $600,000 to $1 million, in that case, weighted average cost of capital will increase to 10.3% from 9.8%. This is due to more cost of common stock because if Duchess Corporation raises more capital, the firm has to pay 14% cost on its common equity. As a result, firm's weighted average cost of capital increases to 10.3% from 9.8%. And finally, if the firm raises $1 million or more, in that case, weighted average cost of capital will also increase, which is 11.5%. This is due to increased cost of debt, which is 8.4%, and increased cost of common equity, which is 40. This is due to increased cost of debt. So when firm raises more capital, riskiness of the firms increases. In the meantime, for common stock, needs to more against farm with 1 million or more capital. So here is a casual for weighted marginal cost of capital. So as per this casual, Firm's weighted average cost of capital is 9.8%. If firm raises 0 to $600,000, then if firm raises 600,000 to $1 million, weighted average cost of capital will be 10.3%. And finally, if the firm raises 1 million or more capital, that case weighted average cost of capital is 11.15%. Here is an schedule for investment opportunities for Duchess Corporation. So we know that Duchess Corporation's so weighted average cost of capital is 9.8% if it raises 0 to $600,000, 10.3% if it raises 600,000 to 1 million, and 11.5% if it raises 1 million or more. Now, if a firm invest in project A, in that case IRR is 15%, which is more than weighted average cost of capital of this firm. In that case, it is an initial investment of 100,000, and cumulative investment will be 100,000. The firm can accept projects A, B, C, D, E, because if firm accepts all these projects, its total investment will be $1.1 million. So the firm can accept projects from, or accept the investment opportunities from A to D, A to E, because from investment opportunity to A to E, firm's internal rate of return is above 11.5%. So beyond this, if firm cannot accept project investment opportunity A or investment opportunity G, because firm's internal rate of return for these two investment is less than firm's weighted average cost of capital. Now let's look at the cumulative investment, how the cumulative investment has been calculated. So if a firm invests only in project A, its investment requirement is 100,000. If firm invests in project B, additional $200,000 will be required. So total investment will be $300,000. Then if firm also accepts project C, it will require $400,000. So total investment requirement will be $700,000. This is how cumulative investment of the firm is calculated, and we also know what could be the cost of capital for a ranges of total investment. That's all about this lecture, and this is the end of cost of capital. In our next module, that is module 4, we'll cover sources of long-term finance.